Prices right now are rising, but at the same time, people are losing jobs. Some economists say we're headed towards inflation, heavier inflation. Others warn about deflation, and a growing number of analysts are talking about something way worse, and that is stagflation. Three economic forces that can completely change how your money works. So today, what I would like to do is break down inflation versus deflation versus stagflation and what they actually mean, why they happen, and most importantly, how you can protect yourself financially no matter which one of these hits. To understand where the economy might be heading, you first have to understand the three major forces that drive economic cycles: inflation, deflation, and stagflation. These aren't just economic buzzwords. They determine whether your savings grow or slowly lose purchasing power. They determine whether assets like real estate and stocks boom or collapse. And they determine whether governments print money or struggle to keep economies from shrinking. Let's start with the one everyone is familiar with: inflation. Inflation happens when prices rise across the economy and your money buys less over time. Think about it like this. 10 years ago, a fast food meal might cost you $6. Today, that same meal might cost you $12. The food didn't necessarily become twice as good. Your money just became less powerful. Inflation usually happens for three main reasons. First, money printing. When central banks inject large amounts of money into the economy, there is simply more currency chasing the same goods and services. Second, supply shortages. If supply chains break down or production slows, fewer goods are available. That drives prices higher. And third, strong demand. When consumers have money to spend and the economy is booming, businesses raise prices because people are willing to pay. Inflation can feel manageable at first, but when it accelerates, it can destroy purchasing power quickly. That's why central banks constantly try to balance economic growth with inflation control. Now let's talk about the opposite force: deflation. Deflation occurs when prices fall across the economy. At first glance, that might sound great. Cheaper goods, lower prices, more purchasing power. But deflation can actually be extremely dangerous for an economy. Why? Because when people expect prices to keep falling, they stop spending money. Why buy a new car today if it will be cheaper next year? Why invest in new factories if demand is shrinking? This creates a dangerous cycle. Spending slows, businesses earn less, companies lay off workers, and unemployment rises. One of the most famous examples of deflation was during the Great Depression in the 1930s. Prices collapsed, banks failed, and economic activity slowed dramatically. Hey, real quick, I want to take a quick break and throw this idea out. If you would like to take advantage of the coming crisis in real estate, I put together a package of 4 courses. The Real Estate Crash Course that shows you the cycles of real estate, what to do during a bear market, how to sell the properties, and so much more. The link's down below if you want to take advantage of buying all 4 courses for a crazy price. Now, back to the video. This is why central banks today are often more afraid of deflation than inflation. Because once deflation begins, it can be very difficult to stop. Now we get to the most confusing economic scenario: stagflation. Stagflation happens when 3 things occur at the same time: slow economic growth, high unemployment, and rising prices. Normally, inflation happens when the economy is strong, but stagflation is different. The economy is weak, yet prices are still rising. One of the most famous examples happened in the 1970s. Energy prices exploded, economic growth slowed, unemployment increased, and inflation surged. It created a situation where policymakers had almost no easy solution. Raise interest rates to fight inflation? That could make unemployment worse. Stimulate the economy? That could push inflation even higher. Stagflation is difficult because traditional economic tools often stop working. So which one should people worry about the most? The truth is, All three can cause serious financial damage. Inflation slowly erodes savings. Deflation can collapse businesses and employment. Stagflation combines the worst of both worlds. And the reason economists debate these constantly is because predicting which one comes next is extremely difficult. Different policies, global events, supply shocks, and financial crises can push the economy in completely different directions. So how do people protect themselves in uncertain economic environments? Historically, investors diversify across different types of assets. Hard assets like real estate and commodities often perform well during inflation. Cash and high-quality bonds can be useful during deflationary periods, and during stagflation, many investors look for assets that produce real income and maintain value. But the most important protection isn't just what you invest in, it's understanding how these economic cycles work. Because once you understand inflation, deflation, and stagflation, you start seeing the warning signs earlier. You start understanding why governments make certain decisions, and you start realizing that the economy moves in cycles, not straight lines. The real advantage comes from being prepared before the cycle turns, and that's what smart investors are always watching for.